Hello everybody. So we are back. So we have already covered the basic terms, what they mean, the accounting equation. I hope you realize the importance of that part to understand which account goes up or down in which transactions, because that really builds the base that you need to have to be great at every other topic we're going to learn. So we already covered the journal entries, and hopefully you saw that it's actually not random to do journal entries. It's actually very logical, right? If you understand which account is going up and down, we are just literally applying the rules of accounting journal entry into recording them. So now we have the step that comes after recording the journal entries, which is the T accounts. So let's go to our journal entries. I'm going to show you here. You know what, I'm just going to make a duplicate of this sheet just in case we also need to see this again in the future. So let's make a duplicate. There we go. Okay, so now we have a duplicate file and the original entries just in case we need the original ones. Okay, so I'm going to remove all of the transactions here so I can show you how do we make the T accounts. So by now, I will guess that you have taken some time and have been able to get the rules memorized. So I'm going to remove this. All right. Now, let's talk about the topic of T accounts. What are T accounts? Why do we need them? And everything like that. So if you're learning accounting for a exam, let me first delete this, sorry. There you go. Okay, so if you're learning accounting for an exam, you have to understand T account in this way. So first of all, let me put the entire accounting cycle that we are going to cover here, so I can teach you in the best of ways. There we go. So what is the first thing we learned in accounting? Accounting equation. Then we learn journal entries. Now, just to make sure until that, what we're doing, accounting equation just helps you understand transactions effect on different accounts. Journal entries are how we actually record transactions into the accounting system, right? Again, by accounting system, I mean an accounting software and things like that. After journal entries, now again, if you're a student, right, this is a good concept to have. So after journal entries, there is still a possibility, right? Like a manager can come up to me and say, okay, Shaheen, I understand that you have recorded everything into the accounting system, but I need to know the total of each account rather than just how much you recorded for each account, right? So obviously we are recording, let's say I'm debiting cash, crediting cash, and they just want to see the total cash I have at this point in time. How will I tell them how much cash we have? That's where the T accounts come into play. T accounts are how we calculate the ending balances of the account, means the total of each account. Now nowadays, just to let you know, if you're learning accounting for a business, T accounts are done automatically. So you don't have to actually do them manually. But if you're a student, this part will be actually very helpful to do T accounts. And even if you're doing it for your business, learning for business, I think it still gives you some value to learn how to do T accounts. So you understand the logic behind that. So to make a T account, we'll simply draw a T. There you go. So we have to make a T account for each account because I need to find the total balances of each account by the end of the year. And why do I need to do that? Because if we go further in our accounting cycle, so we will learn the accounting equation, journal entries, T accounts, and there will be more things until we will also make the financial statements like income statement to calculate the profit, balance sheet to report on the assets, liabilities, and equity. We'll talk about that, don't worry at the moment. But just to let you know, we do need to know the total balances at the end of the year so we can make those reports that we are supposed to make for a certain period of accounting time. Okay, so let's calculate cash. How do you do this? Now again, this is called the T accounts, and these are also referred to as the ledger accounts. It's always good to know all of the terms we use. All right, so if you're doing a cash T account, or any T account, all you have to understand is we basically look at the journal entry. For example, because I'm making the cash T account, I'll look at the journal entry and see if cash is affected. In the first one, yes, cash is affected. Is cash a debit or credit? So cash is debit, so we will put the cash on the debit side. Yes, left side is the debit side, right side is the credit side. That's always how accounting works. So in this case, I'll write 1st of January, we debited $100,000 in cash. So this side is the debit side and this right side is the credit side. Okay, second transaction. Now in this case, a cash is a credit. So on the credit side, I'll write $20,000. And what is the date? It's 5th of January. Awesome. Third one, is there cash? No. Fourth one, is there cash? Yes. It's a credit again. So I'll do the cash credit again by 15,000 and the date will be 12th of January. Perfect. Then on 14th of January, we are receiving cash, means cash debit. So on the debit side, I will write 10,000 and 14th of January. So yeah, it's as simple as this. So here, is there cash account affected? No. In this one, is there cash account affected? Yes. Cash is debit by 15,000. So 15,000 and the date was 18th of January. All right. Then we have a cash credit on 20th of January. So let's do that. So 8,000 cash credit on 20th of January. Awesome. And now we have the final one. The cash is on the debit side in the 22nd of January. So we can write 22nd of January. I think it was, how much was? 30,000. Okay. $30,000. So now we have posted all of the journal entries into the T account, and yes, that's what it's called actually. So this is called posting journal entries into the T account, means putting the journal entries into the T accounts. Now, this is where we'll do the calculation of the total we have now after all of the transactions have been posted. So we'll calculate the ending balance. Again, that's what it means to find the total. Basically, to find ending balance, it's always the total increase minus the total decrease. So we know cash is a asset account and assets increase on debit. So that means I have to do the total on the debit side minus the total on the credit side, because that's the decrease side. So just to repeat that again, to find the ending balance, we do the total of the increase side minus the total of the decrease side. So in this case, total of this side minus total of this side. If I press enter, I just found out how much total cash I have after I've been through all of these transactions. Now, like we said, you need to make this T account for each of the accounts separately, because I do need to know how much of each account I have. It's not just cash. So let's make more accounts, but the good strategy is always to first count, okay, how many accounts am I going to need? Okay, so we are going to need a capital account. Okay, let's write it here. So one account for capital, building account, one account for building, car account, so one account for car. Then we have accounts payable, one account for accounts payable. Then service revenue, we also have to make an account for service revenue. Accounts receivable, okay. And then rent expense and sales revenue. So rent expense and sales revenue. Amazing. So if we count this out, we need 8 more accounts. So let me delete this. Why did I count this here? So first we can just make a format of all of the 8 accounts and then start solving, like that will be very efficient way to do this. So I've made a T account. I'll literally copy and paste it 8 times, right? We already made one, so I guess 7 times more. So 1, 2, 3, and let's do it on this side now. 4, 5. Oh, I guess I misclicked somewhere. Okay, anyways. 5, 6, 7. Or did I miscount? Let me double check. So 1, 2, 3, 4, 5, 6, 7, 8. Okay, that's fine. Like we are already with enough accounts. Okay, so let's name each of the account, right? So here we'll make the capital account. Let's just fill every account in, then just go by one. So we have capital account. Again, let's do the same thing. We look at the capital account. Is it being credited, debited? Credited. So on the credit side, we will write $100,000, and the date is on 1st of January. Now, any other capital effect in any other entry? No. So that means that is the only posting of a journal entry into the capital account, which is usually the case, by the way. Cash is only the account that is affected the most, you know. It again debit, credit, debit, credit, credit, debit. It's just it just keeps going. But every other account is very short. So in this case, we will calculate the ending balance, which will be credits minus the debit, right? Total of the credit side minus the debit side. Since capital is the equity account, it increases on credit, decreases on debit. So in this case, we will do the sum of the credit side. Apparently, it's just 100,000, and minus the sum on the debit side, which is of course 0. There's nothing there. So ending balance is 100,000. And you might notice, I'm always writing the ending balance on the increase side. And yes, that's a generally accepted way to do the total ending balance. Now, if you are learning accounting in a country where IFRS is used, you can write the ending balance on the other side, the opposite side, just to let you know, a decrease side, just to balance it out. So just as an information, you normally put the ending balance on the increase side, but in IFRS, International Financial Reporting Standards, which is what most of the world uses, you'll put the ending balance on the decrease side. A small detail, it doesn't really make a difference. It's where everything is. Okay, in any case, we'll go to the third account, which is called the building. Let's do building. So now I'm going to pick up some pace. So because we have built up the basics, so 20,000 debit, 5th of January, 20,000 debit, 5th of January. Is there anything else about building? I don't think so. So that's it. So we'll do ending balance, which will be 20,000. All right. Next one, we have accounts payable. Okay. Accounts payable. So we have a accounts payable credit 15,000. Credit 15,000, and it was of 10th of January. Okay, then debit 15,000 on 12th January. Okay. After that, do we have any more of accounts payable, or that's it? Yeah, I think that's it. So in this case, ending balance is 0, because the total credit minus the total of the debit side is 0. After accounts payable, we have service revenue account, I guess. Oh, I think we did not do the car account. Oh, sorry, let's do the car account. Okay, my mistake. There we go. So for car, it's just 15,000 debit, and I guess that's all. So 15,000 on the debit side, and it was which date? 10th of January. So very simple. We just keep going with the same approach, and you should not have any problems with these T accounts. After car and accounts payable, we have service revenue. So let's do that. Service revenue. All right. So service revenue is being credited by 10,000 14th of January. So 14th of January, 10,000 credit. Awesome. Let's keep going. Any other service revenue? Yes. Again, 15,000 credit, 16th of January. All right. Oh, sorry, it's 15,000, not 10,000. Let me write 15,000. Okay. Any other service revenue? No, we have sales revenue, but not the service revenue. So let's do the ending balance of service revenue, which is 25,000, of course. All right. After service revenue, which account do we have to make? Accounts receivable. And in case you're wondering, do I have to follow a sequence? No, you don't have to follow a sequence because it doesn't really change anything. But again, if your teacher is saying follow a certain sequence, if you're given an exam, sure, go for it. Like some teachers say, like write the asset key accounts first, then the liabilities, then equity. So if that's the case, do it. But yeah, generally it doesn't really matter at all. So accounts receivable. So we have a debit 15,000. 15,000 debit. It was on 16th of January, I believe. Let's see. Yep. And then accounts receivable credit again 15,000 on 18th of January. 18th of January. Is there anything else on accounts receivable? I don't think so. Okay, so that means accounts receivable also has an ending balance of 0. All right. Some weird things going on here. Accounts payable and accounts receivable are 0. Of course, that's fine because we are that's the real balance. But yeah, I guess unconsciously I've put the debit and credit as equal amounts in the entry. Okay. So we are pretty good so far. After accounts receivable, what account do we have? Rent expense. Okay. Rent expense. So rent expense is only one-time debit to 8,020 January. So 8,020 January, let's do that. So ending balance is 8,020 January. Okay. And the last account is sales revenue. I know you must be tired, so this is a great thing too that this topic is coming to an end. Okay. So sales revenue we have on the credit side, how much? 30 grand. So $30,000. And what is the date? 22nd of January. All right. Now the ending balance is, of course, 30,000. And that's all there is to T accounts. We just calculated the total of each account that we have. For example, total in cash, we have this, total in capital, we have that, and so on and so on. So we literally found out the total balance we have in each account. So in the next video, we'll talk about the next part of the accounting cycle, which is a trial balance.